Our first application deals with the art of making money. How does one make money? Well, a facetious answer might be, well, print it. Of course, there are a couple of objections to that score. That tends to earn us a long stretch under the hospitality of the government. As long as I'm being facetious, what is the difference between the government printing money and an individual printing money? In the former case, it's called economics. In the latter case, it's called fraud. But we are being facetious. Of course, the setting here is how should one invest in a stock market? What governs the growth of wealth in a stock market? Of course, the underlying setting is much too complex to be able to do it full justice in one short introduction. But what we could hope to do is perhaps glean some underlying fundamentals about the movements of this apparently chaotic phenomenon of the stocks in a stock market. And so the question then is, how does one characterize a stock market, and how does one characterize portfolios which govern investment in a stock market? Let us begin by considering the movement in the price of a stock over a given day. On the day I recorded this lecture, I looked at the movement in price of the stock of Apple Incorporated. Now, at the end of the day of trading, one stock in Apple was worth 127.08. Of course, the movement of the stock price is chaotic, random, apparently unpredictable over the course of the day. The natural point of reference for us then is how much the stock has appreciated by the end of the day from where it was the previous day, or how much it has lost ground. And so the natural point of reference is what was the closing price of the stock in Apple at the close of the previous day's trading. And if you look at the right of your figure, you'll find in fine print that at the previous close, the stock price for Apple was 126.46. In other words, there's been a slight appreciation. The percentage of the appreciation is captured in this idea of the price relative of the stock. The relative price at the close of today to the close of the previous day's trading. So let's give it a name. Let's call this the price of the stock relative. Let's call this X, and it's defined to be the price at closing today divided by the price at the close of trading of the previous day. For the given numbers, X turned out to be 127.08 divided by 126.46, or just a smidgen more than 1.0049. There was about a 0.5% increase, an uptick in the price of the stock. And this is fairly typical. In routine days, stock prices move up or move down gradually. And so we end up having price relatives which hover around 1. Of course, if one has a calamity, a very sharp bear market, and the stock prices drop dramatically, then of course we'll have a number much less than 1. If, on the other hand, we have some irrational exuberance, in the words of the former Federal Reserve Chairman Alan Greenspan, if you have irrational exuberance and unbridled optimism, maybe on a given day a stock price might jump up substantially. But typically we expect the stock price relative, X, to be somewhere near 1, maybe just a bit below 1 if you've lost a little bit of ground, maybe just a little bit above 1 if you've gained some ground. All right. Now let us see what might happen if we invest on this day in Apple Computer. Right. So we're going to look at an investment at the close of trading on the previous day, where you purchase a stock or more than a stock, and then we examine what it is worth at the end of today's trading. Suppose we had invested $1 €1, ₹1 in Apple at the close of trading on the previous day. How much is it worth? Well, naturally, it is worth exactly the price relative. So $1 at the end of the previous day's trading is now worth X dollars at the end of today's trading. Of course, we could invest more than $1 or less than $1 in principle. Suppose we invest a fraction A, some real number. If we invest A, how much do we get? Well, it will now be worth A times X. Each dollar gives you X, therefore A gives you A times X. Excellent. We now have an understanding of what an investment will bring us for this stock on this day. But of course, we know that it's dangerous to invest all our eggs in one basket, however pretty the basket. This leaves us completely exposed to the vagaries of stock movements. And so a natural way of hedging against the risk of movements of these individual stocks is to diversify, to invest in a portfolio of stocks. Okay. For this, now we need to consider not one stock, not one company, but an ensemble of stocks. So let's take a look at a stock market. And again, we're going to look at one day of trading. Now, what is a stock market characterized by? Well, it's going to be characterized by possibly several companies and several publicly traded stocks. How many? Well, let us say there are M stocks that are being traded, and the individual stocks may go up, they may go down. Each of the individual stocks then is characterized by a stock price relative for that stock. So let's say there are stocks 1, 2, 3 up till M, and let's say that for the jth stock, over the course of that day, the price relative for that stock is, in a natural notation, X subscript J, or simply XJ. So X1 represents the price relative for stock 1, X2 for stock 2, XM for stock M. Bear in mind, we typically anticipate that these numbers X1 through XM are wobbling around 1, though of course there could be turbulence. They could either be very much larger than 1 or perhaps much smaller than 1 if you have either a bull market or a bear market. But this is what we typically expect. These X's are somewhere near 1. Let's characterize this vector of possibilities, these M possibilities, by giving it a name. Let's call it boldface X. And now the stock market is characterized by this boldface X of stock price relatives. Now, this is telling us what has happened from the close of trading yesterday to the close of trading today for each of the individual stocks. What is the appreciation or the loss in position for each of those stocks? We now have an investment question. Let's say we have $1 to invest. We could invest it all in a given stock, perhaps Apple, or we could split up the dollar and invest it across multiple stocks. This is what is called a portfolio. So what is a portfolio? It is an allocation of our wealth across the different stocks. So let us say again we focus on a generic stock J, and let's say at the close of trading on the previous day, I invest a portion A sub J of my wealth in that stock. Now, that means I invest A sub 1 in stock 1, A sub 2 in stock 2, A sub M in stock M, and these represent the fractions of the wealth that are distributed across these stocks. Of course, since the A sub J's represent fractions, they are numbers between 0 and 1. They could be 0. If an AJ is 0, that just means you've invested nothing in stock J. And if a particular AJ is 1, that means you put all your eggs in one basket, you invested all your money in that one stock. But more generally, you want to spread your wealth around across multiple stocks. And this is the essence of a diversified portfolio. You hedge your risk by spreading the risk across many entities. Again, these numbers A sub j have to be non-negative, and because you're dividing your total wealth across these entities, these numbers have to add to 1. So your portfolio then is a vector of these possibilities. Let's call that boldface little a. So now we have an idea of our portfolio. Let us fix a particular designation of allocation of resources across these stocks. Let's fix a particular portfolio. This is our investment at the end of the previous day's trading. Having invested in this fashion, having spread your wealth in this fashion, what is your wealth worth today at the end of trading? So let's take stock. So we're starting with an investment at the previous close, and now we are asking what is the value of the investment now at the end of today's close? Let's start by saying, what have we invested $1? Now that $1 is split into these pieces. A portion A1 of the $1 goes to stock 1. A portion A2 goes to stock 2. A portion AM goes to stock M. An A1 investment in stock 1, which has a price relative X1, will earn you A1 times X1 at the end of today from stock 1. Likewise, an A2 investment in stock 2, which has a price relative of X2, will have earned you A2 times X2 for stock 2. And so on and so forth. An A sub M investment in stock M at the end of today's trading will have earned you AM times XM. And naturally, your net wealth now is going to be the sum of A1x1, A2x2 through AMXM. Let's give this a name. Let's call this sum, S for sum, of course. But of course, the sum depends upon the particular stock price relatives, boldface X. Depending on how the stocks move, the sum is going to move around for a fixed portfolio A. Right? So let's give it a name. Let's call it S, and of course S depends implicitly on the particular stock price relatives for that day. What if we had a wealth W to invest at the end of the previous day's trading? Well, then each dollar in W will earn SX, and therefore W dollars will have earned you today W times SX. So S of X is now a critical element to look at. What does it connote? It is the amount wealth has grown if $1 were invested over the course of a day where a vector of stock price relatives X resulted. In other words, S of X tells you the ratio of your wealth at the end of today to the wealth at the end of yesterday. We'll call this simply then the wealth relative. The wealth at the end of today relative to the wealth at the end of yesterday. So the game here now is clearly going to be devolving upon the nature of these wealth relatives. Bear in mind that underlying these experiments is going to be a chance phenomenon, a very complicated chance phenomenon. So in general, the X's are going to be chance-driven, and we are not going to be a priori able to predict what an X is. If one could, of course, we could make a lot of money very quickly. So the wealth relatives, S of X, are themselves chance-driven and dictated ultimately by the choice of portfolio. So this is what is going to be coming up next. Let us now look at what happens when we look at not one day of trading, but a succession of days of trading.